Good afternoon, dear traders. Today, oil in focus of our conversation. The oil market remains one of the key indicators of how investors assess developments in the Middle East. Over recent weeks, prices had been trading with a significant geopolitical premium, and the main concern was the risk of disruptions to oil exports through the Strait of Hormuz and the possibility of a broader regional escalation involving Iran. However, by June 15th, the situation had begun to shift. The United States and Iran signaled their willingness to continue diplomatic negotiations, while discussions increasingly focused on de-escalation rather than direct confrontation. The reopening and normalization of shipping routes through the Strait of Hormuz significantly reduced fears of immediate supply disruptions. At the same time, it is important to remember that the market always trades expectations rather than current conditions. Even if strategic reserves and commercial inventories still need time to be replenished, traders are already looking several months ahead. The focus is gradually shifting from supply shortages toward a future environment of weaker demand growth and potentially higher global supply. Several additional factors are reinforcing this view. First, the United Emirates' departure from OPEC has increased its flexibility regarding future production decisions. While this does not immediately flood the market with additional barrels, investors understand that supply discipline within their producer alliance is becoming less predictable. Second, Venezuela continues to represent a potential source of additional production growth should export restrictions ease further. Third, global economic expectations are gradually moving toward slower growth. Higher energy costs, tighter financial conditions, and weaker industrial activity are encouraging traders to price in softer oil demand over the coming quarters. From a technical perspective, the 88 till 104 area can be viewed as the range where the market was actively pricing elevated geopolitical risks. The recent move below 88 suggests that traders are increasingly betting on diplomatic solutions rather than further escalation on the Middle East conflict. In other words, the market is no longer focused on the risk of supply disruptions. Instead, it's beginning to price in a future characterized by slowing demand, normalization of geopolitical tensions, and potentially greater supply availability. As long as prices remain below their former geopolitical premium zone, the market is effectively signaling that diplomacy is gradually replacing conflict as the dominant narrative for oil.